The worst is certainly behind us for the Netherlands business. Because we had a problem with the blast furnace last year. We had a relining which took longer than we had planned. The blast furnace is back in operation, so you will see quarter-on-quarter improvements. This quarter will be better than the previous quarter, so on and so forth. In the UK, you will see two tough quarters, which is Q1 and Q2. But in the end of Q1, in June, we plan to close the first blast furnace, and in September, we plan to close the second blast furnace. And after we do that, you will see UK also in the positive in the second half of the year. So this year is going to be a very crucial year. Turnaround in Netherlands. Last year was a loss. This year will be a profit, at least at an EBITDA level. And the UK second half, we hope to move from a loss-making facility to at least a balanced facility.
Okay, so you are indicating that in the mid of this financial year, break-even can be achieved in the Netherlands business?
No, Netherlands will be positive from this quarter itself. UK will be positive from Q3.
Okay, excellent. That is pretty heartening to hear. Sir, can you also tell us, you'll commence this assets in June in the UK business. The numbers will start reflecting it by when? And what kind of discussions are you having with the trade unions there?
Well, so the first phase is what we are already going through. We closed the coke ovens in March, more for operational reasons. We were anyway due to close it in June. We had to close it by March. There are two blast furnaces in the UK. The first one will close by June, and the second one will close by September. That's a conversation going on with the unions. Obviously, unions are not very happy with it because there are job losses, but we've given them a very, very good offer so that the package or the separation is as generous as we can afford. It's much better than what's required from a statutory point of view, much better than what we've offered in the past. But that's for us to make sure that we do this transition as smoothly as possible. So by September, the heavy end of UK will be closed, and we will rely on imported slabs and coils for some time to take care of our customers, because we have customers in UK who will want to be supplied. And in the next 3 years, we will build the new electric arc furnace in the UK and go back to making steel in the UK like we've done in a much more efficient and effective way.
Right. Let's shift focus, Mr. Narendran, to your India business then. India operations continue to show resilience. Talk to us about how higher coking coal consumption is weighing on your spreads in the numbers, and also is China factor still an issue as far as the pricing is concerned?
So coking coal prices have settled in the last 2 quarters. So last quarter, actually, the consumption went up by about $5 a ton. We had guided 10, so we managed to keep it at around 5. This quarter, we expect the consumption cost to drop by about $10 a ton compared to Q4. Our purchasing of coking coal on an average this quarter is about $30-$35 per ton lower than what it was in Q4. So you will see a little bit more of the coking coal benefit flowing through in the next 2-3 quarters in India. We are also working a lot on the different blends that we use, so that we use less and less of prime coking coal and use other coals which are not so expensive in our production. As far as China is concerned, the concern really is that China is exporting 10 million tons a month, which is the highest at a level at which we've seen Chinese exports in many, many years. It is not flowing so much into India yet, but it has a huge impact on prices in Southeast Asia particularly, and the rest of the world. Indian imports have started going up. We've been representing to the government that at some stage we will need to take some action, because the Indian steel industry, not just Tata Steel, everybody else is investing a lot of money in building steel capacities in India, and you don't want to derail private sector capex, because of unfairly priced imports.
Mr. Narendran, just a quick word on the demand on ground, the main sectors which you feed onto, real estate, infrastructure, autos, if you could tell us. And also a sense is that right after elections, again, the focus on infra would restart. So do you see that demand momentum to pick up?
Yeah, I think demand has been strong in India, and that's why all of us in India have been able to sell most of the steel that we produce in India, and have been less impacted by the international markets, the sentiment in the international market. So even for Tata Steel, exports is now less than 5% of what we produce. Traditionally, it's been 10% or maximum 15%. So the demand has been strong in India across sectors, driven certainly by the auto sector, which has had a great recovery, particularly if you look at commercial vehicles, which has been lagging 2019 numbers for quite a few years. So passenger, commercial vehicles, tractors have been strong. And in the last 6 months, we've seen the two-wheeler business also pick up. So auto is in a good place. Once in a while, they have a soft month or so, but otherwise they could. Construction has also been quite strong, though I expect the road construction to lag a little bit. I've been reading about it also, that it's more about peaking at maybe current levels and sustaining it for as long time as possible. But you see commercial structures are strong. GCCs are helping commercial retail space. Industrial structures are strong because there is investments in supply chains and factories, etc. So 6 months back, our concern was more the rural markets, but we are seeing rural markets picking up a little bit over the last 6 months. Urban markets have been strong, and auto and construction have been quite strong. So we expect that once the elections are over and you know we are all back to normal in terms of work, some of the activity will pick up again.
Right. And leave us with your thoughts on the way debt is panning out now, improved financials, and the outlook is looking good. Would that speed up your debt reduction plan as well going forward?
So one goal we have for this year is to bring the net debt to EBITDA, which is currently at 3.2, 3.3 level, to below 2.5. Okay, that means actions more on the EBITDA side than on the debt side. Debt will be flat this year as of now, simply because we are seeing the peaking of expenditure in India as we complete the Kalinganagar project. And we have a residue of some of the expenses that we incurred last year in the blast furnace relining in Europe, etc. And you will see start of the capex on some of the engineering work in the UK project. So I don't expect the debt to reduce significantly. It will be flattish this year, but I do expect the net debt to EBITDA to come to below 2.5, which was one of our stated goals.
Excellent, Mr. Narendran. Thank you very much for your time, sir. Great
Thank
chatting.
you.